About our
valuation model.
I'd like to segue into financial reform. I know that you are very vocal about changes that you'd like to see in the investment industry. Do you think that the financial reform package that was passed earlier this year goes far enough? Does it address the right things, in your view?
Well, first, only in America can we appoint a commission to study the causes of the crash in the stock market and pass a law to deal with them 6 months before the commission makes its report, because the law was passed in July, and the commission, which is not, I don't think, a particularly impressive one, is going to send out its report, I think, at the beginning of December. So we got kind of a chicken and egg problem there. The first thing I'd say about financial reform is we just don't know. In other words, so much has been left to regulation. Capital requirements, quality requirements, portfolio quality, and security requirements have been left to the regulators, that it's hard to say where we are. Third, I think what we have is better than nothing, but still didn't do as much as it should. I mean, I really believe that we should bring back Glass-Steagall Act that separated commercial banking from investment banking, and let the bankers bank. Take in deposits and lend the money out. That's conventional banking. And when they get into all these peripheral activities with that kind of government guaranteed now for those deposits, they got into a lot of risky areas that they shouldn't have. And I think we ought to be rethinking deposit insurance. I understand that Sheila Bair, who's the chairman of the FDIC, Federal Deposit Insurance Corporation, is going to be very tough on guaranteeing anything but the deposit base of a bank when it goes belly up. She doesn't want to guarantee their debt, anything that's lent out to, the big world out there. And she's right. But we didn't do that, for example, with Citibank. All that debt was protected by the government, in effect. And I don't think that should have happened. There have been other calls for having banks issue some subordinated debt that everybody knew would go if the bank went. It'd be interesting to see what that interest rate would be and how it would change. But I don't see why the federal government has an obligation to bail out investors who should know what they're doing, but even in the professional management business often seem not to know what they're doing. I'm disgusted and disappointed with the level of analysis I see among professional security analysts, bond and stock alike.
Jack, I want to follow up on the SEC's proposal to reform the 12b-1 rule. What's your take on that?
Well, we are in the happy position of having abandoned Salesforce about the first or second. The first thing we did when we started Vanguard in '74 was bring out the index fund, which came out finally in '76. We started operations in '75. The index fund came out in '76. And then we went no-load in '77 and got out of the dealer business, which we'd been in for 50 years. And so I haven't felt it necessary to keep up with 12b-1. But I think it should just be eliminated, honestly. And the new, quote, reforms, quote, I don't think fundamentally alter the problems with 12b-1, and that is sales charges are hidden from the buyer. They're made to look minimal. And if you have any understanding about what increments of fund costs are, how much they matter over the long term, 0.5%, 1% is a lot of money over an investment lifetime, a devastating amount of money over an investment lifetime. I'm sure there are a lot of reasons it would be difficult, but let's just call it a sales charge. And here we are, and you pay the commission, and if you don't want to pay the commission, buy a nice no-load fund, but have a little more clarity. The SEC, honestly, I think pays much too much attention to the Investment Company Institute, or trade association, which of course purports to represent fund investors, which is a big joke. The Investment Company Institute represents fund managers. They're lobbyists for fund managers. And to portray themselves as the advocate for fund investors is, one might say, a bit much.
There's a new Consumer Financial Protection Bureau that's being started up. Wondering if you have any advice for Elizabeth Warren, who is charting the course for that new bureau.
Well, she's pretty tough, and I think that's what's needed. And I can see why she's not popular in the banking industry, but a tough regulator isn't going to be. And it's sort of a mysterious part of the process that they didn't think they could get her confirmed, and I think they were probably right in that, by the way. But I would say don't forget mutual funds. Now, her charter is broad enough to look at mutual funds, but I don't think mutual funds are mentioned there. But I think she has the authority to do that, or will have. And so I'd say don't forget mutual funds, because this industry, its problems are much more subtle than the problems that we've seen in commercial banking and credit cards and those kind of things. But nonetheless, an industry that has a long way to go to measure up to its mandate, which is, I would have said, to be good stewards of the money entrusted to us by American citizens.